Hi everyone, my name is Victoria. I'm 21 and I have participated in the Indian and US capital markets for the last 4 years now. And I'm also part of the finance value chain now that I'm working full time in this industry. I graduated with a degree in business administration with a specialization in finance from NMIMS just almost a year ago. And since then, there hasn't been a day that I have not tracked the markets actively, right? What you're seeing behind me is the India VIX, the India Volatility Index. And there is a specific reason for why this is my chart. This is an old capture, right? This is not the latest chart of India VIX. But I like to think or approach the markets from a risk first perspective. And I believe returns are all sorted if your risk is looked at. So this is the reason for choosing this as my background. But yes, with the context set and with the introduction in place, I'd like to talk about the things that matter today, the things that you have to track beyond headlines, because they're just narratives and stories thrown around. That's not real investing, that's just investigative journalism, right? So here are a few things that you can track on a daily basis and build directional conviction decisively. And I will try to break each of them in detail and why it matters in a separate video. But this is a quick understanding of what I am tracking on a daily basis and how I'm building directional conviction in market environments like today. Right. So diving right into the video or this topic, first we'll start off with, of course, the the broad markets, right? Nifty 500. So if you're a long-term investor, if you're a trader, and if you track the markets on a daily basis, I'd like to urge you guys to move away from analyzing Nifty 50 and start analyzing the Nifty 500. Why I say that is because while we make allocations in mid cap and small cap mutual funds, indices, and pick stocks from that space, our whole analysis is based on Nifty 50, which is in some way a barometer of the Indian stock market. And I have a problem with that because these are the top 50 companies in India according to their free float market cap. This is the large cap space. If you're making decisions of buying stocks in the mid and small cap space just because Nifty 50 is doing well, that's not the right ideology to have. So migrate to the Nifty 500 chart. This is the real deal. This gives you a sense of all the three market cap segments in one place. And this is what you have to start tracking day in and day out. If you're doing daily analysis, the two time frames you can use is, of course, one is the daily chart. But apart from that, the 4 hour chart and the 75-minute chart. This will give you a sense of what's really happening on an intraday level, right? Any chart below that is going to give you so much noise that you will not be able to take decisions with any conviction, right? And for any sort of analysis going forward, I will always stick to the daily chart unless it's specifically required, right? So number one is the Nifty 500 daily chart that you have to track on a daily basis. What I'm seeing right now is I'm seeing accumulation from institutions. There is institutional interest because I am seeing volumes which are above the 50-day simple moving average of the volume, which is greater than the average volume. So there is interest in, of course, this index, which is the broader index, and you can certainly track the total market index as well if you wish to have a broader universe. But typically, I like to stick to Nifty 500 as a universe and select stocks from that. This makes sure that I'm investing in liquid stocks and not getting trapped into stocks where there is no volume, etc. Right? But of course, selecting stocks from Nifty 500 does not ensure that you have to do your own liquidity analysis. But this is a great way to filter out the junk, right? So Nifty 500 daily chart is something you have to analyze. What I'm seeing right now is I'm seeing that there have been 3 sessions when the Nifty 500 has closed above the 50-day simple moving average. Don't try to use many technical indicators. All of them are lagging. Price is the eternal truth. Volume is the eternal truth. And these are the two most important factors on a chart. Stop looking at chart patterns and making decisions. You have to get to the spirit and the anatomy of the chart. That is how you can build conviction, not through looking at a cup and handle and buying, or looking at a high tide flag and making a purchase. That's not how trading or investing works. Now, I am seeing a decisive close above the 50-day simple moving average from the past three sessions, and also seeing relatively higher volumes. This tells me a story that there is institutional interest in the markets right now. There are multiple people investing, and these kind of volumes just don't come with retail traders. A large part of the volume, which really drives the returns, comes from domestic institutions and foreign institutions. They are the ones which will typically move stocks, right? And markets are a demand and supply game. If there is enough interest from these institutions and the smart money is buying that share of stock which you're tracking, that is a great sign, right? So it's important to track the price, the volume, and the simple moving averages of this Nifty 500 chart on a daily basis. What this tells me right now is that from a medium term perspective, or rather a short term perspective, the markets are moving up. And time and again, markets, when they're recovering from the bottoms, move above above the 50-day simple moving average, and then start either a rally upwards or start moving downwards. So this becomes an extremely important level or simple moving average to track. And there is a simple reason for why it works. It's because everyone's tracking it. Your pension funds, your hedge funds, your mutual funds, your FPIs, your family offices, everyone's tracking the 50-day simple moving average, the 150-day simple moving average, the 200-day simple moving average. This is a great way to understand what the market is telling you. This is a great way to build directional conviction. I am waiting for the Nifty 500 to close this downside gap which was created when this whole conflict broke out. So on the 27th of September, the index dropped suddenly by 1.43%, and this gap down was created. Once this gap down is decisively filled, I will have more conviction in taking bets from the Nifty 500 universe. So this is the chart that you have to track. This is the sort of analysis that you can do. This is number one. Number two is market breadth. Now, I'm not going to try and go into the nitty-gritties of market breadth and why it matters in this video. I will try to break it down in a separate video. But in one simple way, or in one simple line, it is the number of stocks or the percentage of stocks that are trading above their 200-day simple or exponential moving averages. Why this matters is because if a larger set of the market is moving above its 200-day moving average, or 50-day moving average, or 150-day moving average, you can of course choose whichever time period you like, but these are medium, long, and short-term moving averages. So if a larger, coming back to the point, if a larger part of the market or a larger cohort of the market is moving above this key moving average, it means that the short term, the medium term, or the long term trend is changing depending on which one you're evaluating. So I try to stick to 200-day moving average to really understand market breadth, because 200-day moving average is, in my opinion, slightly more important than the 50-day moving average, but you have to track all of them, right? So a big shout out to SOIC for creating this tool, stockscans.in, and I will try to link this in the description of this video and you can look at it on a daily basis. I have tried to, keep the range between 27th February and 17th April. 17th April was the last trading day, at the time I'm making this video, and 27th Feb is when the conflict broke out. Since that time and today, what is the market breadth like? How is the market behaved? What is the strength of the market internals is something that we can judge through this. So I would like to focus on this particular area, stocks with price above EMA 200. EMA is exponential moving average 200. I like to stick to the simple moving average 200, but EMA is, uh, you know, you know, it will give more importance to the recent days, which can essentially give you a clearer picture of what's really happening today, right? So when the war broke out, or this whole conflict broke out, I'd not like to call it a war, but for a lack of a better word, let's stick to a war. The market breadth was at 33%. What that means is the percentage of stocks which were trading above their 200-day moving average were 33%. Now this number is 46%. At the bottom, this number was 17%. When market breadth improves, that is a clear sign that there is something that you and I don't know, but the markets know about the entire situation, and they're trying to price that in, right? So if you see an improving market breadth, right, it is a good sign, from the markets that, hey, it might be time to deploy. It might be a good time to start your swing trades or positional trades. Now, when I say market time to good time to deploy, the best time to deploy was probably 20 years ago, right? But you and I are positional and swing traders. We have to make sure that the risk reward metric that we track is in our favor. And to build directional conviction, this is another way, to build directional conviction. So if you see market breadth improving, it means the market internals are improving, the whole situation is improving, and it's extremely important to track this. Same way you can track stocks with price above 50-day exponential moving average, and this number is at about 84%. This would be probably a short-term trigger. This would be, a long-term trigger, and this is something that you're more interested in to build real conviction, right? So that's number two, which is market breadth. The third one is the advanced decline ratio, right? Now, I don't like to look at advanced decline ratio on a weekly basis. You can certainly do that. This is something that I like to do on an intraday basis. I don't do intraday trading. But when I'm deploying my capital, I will certainly come down to a time frame, which really indicates the market volatility on the day of deployment, right? And this chart helps me with that. If I make a decision to take a swing trade tomorrow because XYZ criterias of my setup are being, all of them are being checked, I will come to this chart. I will try to see if the overall markets are moving up today. I'm not going to fight the trend of the markets, right? If the advanced decline ratio chart of the market is not favorable, which means the declines are greater than the advances, and even if your stock is moving up, and it's qualifying for all your criterias, there is a very high chance that at the end of the market bell on that day, you will probably lose money, right? So while your time frame may be 1 week to 4 weeks on a swing trade and much higher on a positional trade, if there is a way to better your market entry timing, and of course in line with Mark Minervini's specific entry point analysis, if there is a way to better my chances of not going into any loss and entering at a very precise level, why not, right? And this tool helps me with that. So if this chart was inverted on any market day wherein the declines were significantly higher than the advances, I would probably wait to deploy fresh capital into any stock, right? The third one that I'm tracking today, oil prices, right? And I cannot give you, or rather give enough emphasis on the oil prices, right? There is a lot of evidence, um, if you go back to the historical levels and try to track oil during distress periods, that the headlines will always show something, right? And with the unpredictability in a world like today, with of course Mr. Donald Trump tweeting and making changes into his whole decision making process day in and day out, what do I rely on, right? I cannot rely on Mr. Donald Trump's comments. I cannot rely on headlines. But this is something which I can rely on, uh, with full conviction, right? If you've observed and if you've been tracking the markets from the past couple days, Every day when you see a red candle on the Brent crude chart, the markets have zoomed, right? And every day there is a major spike in the oil prices, the markets have sank, right? Both US and India. So this becomes an extremely important indicator because oil is an input cost to many industries. Oil prices going up is not advantageous to an economy like India, right? We don't produce oil from the ground up, right? We are importers of oil. We may be net exporters of petrol and diesel products after processing, but the real raw commodity, which is of course crude oil, comes from the Gulf countries, and which is why, of course, and the US as well, which is why there is a major supply shock today because of all the Strait of Hormuz being blocked, etc. And that is the reason you're seeing spike in oil prices. That spike directly correlates to the profits of companies on the Indian stock market as well. So if my Brent crude is cooling off, that is a great sign for me, right? And if my Brent crude is cooling off decisively, if the Brent crude is coming down and cooling off, giving me signals that it is probably in a downtrend, that is a great news for me, right? So I am actively tracking Brent crude. I would urge you guys to do that as well. Try and stay away from the headlines because they are narratives and stories. That is investigative journalism and not investing or trading. This is what you really have to track and do it diligently. Next one is, of course, the US dollar index, right? Now, I will leave this to your discretion that if you want to track this or not, but in many ways, this is extremely important, right? You can ignore the volumes because this is not reliable for Forex. But what I'm trying to say is that if the rupee is weakening, that's not a good sign for us. If the dollar is weakening, that's a great sign for us, right? At its peak, we were somewhere around 95 rupees per dollar. Since that level, we have come down to about 92 today, and that is a great sign for the Indian economy. I'm not going to explain why. It is basic macroeconomics. I might do that in another video, but this is an extremely important indicator to track. And to cut it short, if the dollar index, which means the US dollar is strengthening, that is a bad sign for us. We would have to pay more rupees to get $1, which is a bad sign for us and the Indian markets. The other way around, if rupee is strengthening, which means that we have to pay less rupee to get $1, that is a great sign for the Indian markets, right? So I'm not sure if all the statements that I said align with what you're looking at, but this is definitely extremely important to track, right? So these are a few things that I track day in and day out. Starts off with CNX 500 in summary, market breadth, ADR, Brent crude, and the US dollar index. I apologize if any of you guys don't have a background in finance because all the terms that I said would probably be relevant to a person who has some context about the whole situation, etc. But don't worry, I will certainly try to break down each of this concept in detail on my YouTube channel now. And we'll try to be consistent and help you guys understand what I'm learning. And I will certainly try and break down these concepts for you. I will certainly try to impart everything that I have learned, and I will make sure that I'm learning in public with you guys, right? So that is it for this particular video. I will end this in a very cliche way by saying that please subscribe and like and leave a comment. It will probably help me stay motivated. And well, regardless, I'm going to make these videos. And yeah, I will see you around in the next one. Happy learning and goodbye.